Hello, everyone. My name is Philip Palumbo. I'm the host of the Palumbo podcast, where we interview founders of businesses as well as different strategists as it relates to the markets and the economy, which is all important to us as business owners. Today, we are lucky to have with us Veneta Dimitrova. She's with NDR Research. As a firm, we do a lot of work with NDR. They're a very bright firm, very analytical, and really put out and make some great calls. So, Veneta, thank you so much for your time today. I really appreciate it.
Thank you for having me on again, Phil. It's a real pleasure being here.
It always is a lot of fun, and you're always informative. So I'm excited about this. All right, so the general question, as you can imagine, is we're coming into 2025. We had a good 2023, a good 2024 in terms of economic growth, and here we are moving into 2025. What is your view of the economy coming into 2025?
We are in a good place, right? I mean, we just got the Q4 GDP report today, and it showed that the economy grew at a robust pace at the end of the year. Clearly slower than in the previous quarter, but at 2.3% annualized growth in Q4, it is still quite strong. Now, just for Q4, the biggest drag came from the change in inventories. But if you take that out and just consider final demand, which is GDP X inventories, you still have a growth, underlying growth of about 3.2% annualized rate, which is just in line with the long-term historical average, and tells you that underlying demand in the economy remains strong. And what stands out the most is the strength in consumer spending. So for that particular report, consumer spending stood out the most. A lot of it was maybe some preemptive buying, pull forward in demand in anticipation of tariffs for next year. But even with that, if we account for that, consumer spending was still strong. So that's a very strong position for the U.S. economy to enter into 2025 from. Given those trends that we're riding on, the waves we're riding on from 2024 into 2025, we expect growth to remain relatively robust and project real GDP of 2 to 2.5%. Slight moderation from where we were in the prior 2 years, and particularly in 2024, but still relatively strong growth. And that is predicated on pro-growth policies from the Trump administration that will feed into expected growth, as well as continuation in that consumer resilience that we're seeing.
Yeah, so as I always say, so as long as we have strong job growth, which appears that we do, and even the leading indicators looking at jobless claims, it's still very strong, then consumers are going to have money to spend. Isn't that pretty much the way it works?
That is the basis for it, right? The fundamental support for consumer spending comes from labor market and income growth. And this is where we see, continued resilience. I mean, I keep using that word, but it applies in full strength to the labor market. We have seen a decline in the hiring rate, but layoffs remain very much subdued. Initial jobless claims, continuing jobless claims, all of these things tell you that businesses are holding on to their staff, even though they may not be creating as many jobs as they were a couple of years ago. So there is this newfound balance, if you will, between labor demand and labor supply. And the labor market is pretty much in a good place now. There are basically just enough jobs for people looking for work. So that kind of predetermines this good balance for the labor market, and it prevents wages from declining in a precipitous way. So as long as that is the case, consumer, as you said, will have enough income growth to keep on spending. But it's not just that. In 2024, one of the underestimated influences on consumer spending and growth was the wealth effect, both from gains in the stock market as well as continued growth in housing values, right? So that wealth effect propelled people to spend more, and as long as we remain in that good place, consumer spending will be well supported going forward as well.
But then it almost feels like we're in this like Goldilocks environment, right? When the Fed started raising rates back in March 2022, and many people, including me, anticipated some type of a recession. And maybe we had a rolling recession, especially in manufacturing. It seems like there's some improvement there. But overall, it seemed like we really skirted any type of recession, which is amazing. And then now you see GDP growth, between that 2 and 3%, real growth numbers, which is great. And we continue to forecast some weakening this year, but then, eventually some maybe even, there may be even things getting stronger or strengthening as a result of some of the Trump administrative policies. So this Goldilocks environment, then you have artificial intelligence and the value add to the economy in regards to that. Maybe productivity finally increases. Are you surprised by this incredible environment that we're in right now and how robust the economy is in your view with your experience?
Yes and no. Like a true economist, right?
Yeah.
A couple of years ago, if we were looking at the leading indicators and knowing how the economy has performed during previous tightening cycles, as you rightly observed, a fast tightening in monetary policy would have led to a more significant slowdown in economic growth, if not a recession. And typically it takes like about 2 years or so from the start of a Fed tightening cycle for the economy to fall into recession. We never saw that this time around. And one of the reasons was the wealth effect, like I already mentioned, but also the significant step up from the federal government and government spending overall, including state and local, during COVID and in the recovery post-COVID to support growth. All those excess savings and excess liquidity that flew through the system, through the economy over these past several years have been sort of like a backbone to overall growth. So if you remember a few years ago when the Fed was about to embark on the tightening cycle, and they had already started, raising rates, at the Jackson Hole meeting, if I'm not mistaken, Powell was making a comment about significant pain for households and businesses going forward, stemming from the tightening in financial conditions that he was foreseeing with higher interest rates that they were, just about to embark on. But that never happened, right? So even the Fed was surprised by the resilience of the U.S. economy, which stemmed from that excess support that the federal government had provided to businesses and households. So if to answer your question directly about me personally being surprised, I was a little bit, but in retrospect, it's very easy to justify it, right? And when it comes to a recession call, we follow not just single indicators, but a slew of indicators that give us a broader view, right, of the overall economy. And we, despite highlighting an elevated risk of an economic slowdown or recession a couple of years ago, never did make a recession call because there was never enough evidence to justify one. Yeah. So from that perspective, just leaning on evidence, I was not surprised that we did not enter recession.
So as we talk about it as a team, we're saying to ourselves, like a lot of this economy or this economic growth that we've seen is due more to government spending than to true growth or real growth, right? I'm wondering, do we anticipate, or does your team anticipate government spending continuing in 2025 and in 2026? And if it does drop off, what do you think that means to the economy?
Well, in terms of anticipating what's going to happen, we have to look at what the fiscal policy proposals are from the new administration in Washington, right? So just going by whatever was, mentioned on the campaign trail and what the priorities set forth so far are, we would expect the government support will continue, right? The tax cuts, deregulation, all these other things that have been mentioned by now President Trump have been assessed to cost in terms of budget deficit estimates vary depending on which institution you follow, but about $7 to $8 trillion over a 10-year horizon. That's right. Not a chump change, right? So just going by that, the proposals that have been put forth should expand the government budget, right? And technically that's stimulative to the overall economy because it adds to that liquidity into the system. So from that point of view, I don't expect significant tightening in fiscal support for the economy this year.
Yeah. So going into the Fed, so the thing about the Fed, I always thought last year in like the August period, I said to myself, I wouldn't be surprised if we raised rates 25 basis points, just because really inflation was and is not still under control. The path has been downward from where it was, obviously at its all-time peak, or at its peaks that we've seen since the 1980s. But since then, it's come down precipitously. But now it's been pretty much almost kind of steady Eddie where it's at. Which for me, if you got a robust economy and you got inflation still problematic, and forget about like the measurements that the government uses. The reality is that when all of us go to buy a car, go to the supermarket, we're still seeing prices higher, going to restaurants, all the things that we spend money on. And it's the reality of things. So in your view, do you think the Fed, I believe he paused for reasons I'm talking about, but do you think at some point he'll raise rates this year?
Well, from the current vantage point, I would say no. Raising rates is probably unjustified, in my opinion, at this point in time, despite all the factors that you listed. Yes, inflation is still above the Fed's target and price levels are much higher than where people want to see them. But inflation has made progress over the last couple of years, 2.5 years, towards that, venerable 2% target, right? So, there is still progress being made. The labor market, like we said, is in good place. So, inflation pressures, higher, I should say, inflation pressures are not coming from the labor market, right? There's no wage price spiral of any kind that it's boosting inflation expectations to drive actual inflation higher. But when you look at the Fed funds rate, you have to just not look at the nominal, but also the real, where that Fed funds rate is relative to inflation and inflation expectations.
Right.
And on both measures, it is still very much positive and
Right.
higher than what historically has been considered a normal or neutral Fed funds rate. So from that point of view, the Fed is still restrictive. They don't see the need, and neither do I, for hikes at this point, given that the overall economy is growing at a solid pace, not accelerating. The labor market is in a good place, not tightening further, and inflation has made progress towards 2%. Where inflation goes from here is a totally different question, right? So if one of those mandates in employment versus inflation goes berserk and is no longer considered what they call in a balance, then we can have a different conversation. But where we stand right now and what the outlook for the labor market and inflation are for the year ahead, there is no reason for them to raise rates. Rather, they should actually cut them more to get closer to neutral.
Right, to just educate our audience, Veneta, a bit, right? And so the Fed fund rates right now is 4.25 to 4.5.
Mm-hmm.
Okay. And inflation, to understand neutral or if we're restrictive, we'll use what? CPI. So it's 4.25, 4.5 minus CPI of 2.8.
Yeah, let's call it 3. Yeah.
Okay, so we'll plus 1% approximately. So, and historically, that delta has been what?
Well, closer to 0.5%. So zero. Whenever you have a positive real Fed funds rate, depending on the inflation measure you use to come up with the real rate, that means that the Fed is in a way restrictive, right? But anything above like 1% or 0.5%, anything above 0.5% is technically restrictive for the economy from a historical point of view.
Right. So what is the big deal if I'm the Fed and I say, we're not going to use 2% anymore, we're going to use 3%, and we stay at 3% the next 20, 30 years? What is the problem with that?
There is no problem. I mean, the 2% target was selected artificially, is not the right word probably, but it is the right target across various developed economies. And it's a relatively recent election, let's call it, right? It hasn't been historically the case. It has proven over time that 2% is what is consistent with good growth for the economy, for any developed economy. And because it has been the goalpost for quite a few years, it doesn't make sense from a credibility standpoint for the Fed to change it now. So even though they don't expect inflation to hit that target in 2026, in 2025 or 2026, they're not going to move it, right? They're in the process of updating their procedures right now, which is a process that they do every few years, right? And 2025 is one of those years. He made certain to repeat at the FOMC press conference yesterday that changing the inflation target is not on the table. And it really makes no sense, right? If you're chasing a target and you end up, changing it midway, that kind of hits your credibility. And that's precisely what we don't want to do. So whether it's 2% or 2.5% or anything between 2 and 3% is, relatively good inflation, as long as it stays, within those ranges and edges towards 2%, I would assume that the Fed would be happy.
In terms of wages, right? So wages have gone up, but real wages is still problematic, right? Do you agree with that?
Well, problematic is a big word, right? Real wages have been growing for the past two years or so. So
Right.
Consumers have been getting a headway in terms of earnings and income growth, and that's one of the reasons why consumer spending has behaved as well as it has, right?
So real wages have gone up the past 2 years. I thought they've gone
Yes.
down over the past 2 years.
No, they have gone up. As inflation has been coming down since the middle of 2022, it has been coming down much faster than the moderation in nominal wage growth. So you end up with a slightly positive year-to-year growth in real wages.
Right. Okay.
Yeah.
That's right. So
same goes for real income overall, not just for wage growth, but real income, which includes other things, not just labor, but rental income, let's say, and the proprietor's income. All of these things combined have actually resulted in when adjusted for inflation, in positive growth.
So do you believe that we'll get to 2%?
On inflation?
Yes.
Not in the near term. That's not my expectation for 2025 at all. Maybe we will, but if we do, it doesn't seem that it will be on a sustained basis. Right now, the components of inflation that are driving the disinflation trend are mostly in housing. This has been the stickiest of all components. Housing prices went up way too high earlier in this expansion. They're coming down moderately so now. That's in CPI shelter, right? And the expectation is that they will continue to moderate further during this year because we're already seeing signs in private rent indices, as well as existing home prices from private surveys, that housing inflation has stabilized at levels that are comparable to pre-pandemic. So let's say 3 to 3.5%, right, per year. So because of that moderation already taken place, and the lag that it takes between the actual real data to filter through the CPI shelter component, it is expected that shelter CPI inflation will continue to come down for the remainder of this year. Perhaps it's not going to go back to as low as it was prior to the pandemic, but it's trending in the right direction. Yeah. Further moderation from there is, probably hard to justify. But the thing that sticks out in the inflation outlook more so than the shelter is the outlook for goods prices. And here is where the uncertainty lies. Because if we do end up with tariffs, which is very much likely, those are a direct impact on goods prices, which have been in deflation for the or declining year-to-year basis, I should say, for the past several years, right? So that has pretty much run its course, and tariffs will push it higher at the same time as you have sticky services inflation. So overall, the balance seemed to be keeping inflation in ranges similar to where it is today. So let's say 2 3/4 to 3 1/4 at the end of this year, and even for the balance of this year. So not much movement overall when you consider the ups and downs in the individual large components of CPI.
And that's why I believe rates where they are right now will stay where they are, and maybe even move up higher, especially on the 10-year. But I want to transition now to Scott Bessent. I'm not sure how much you're following what he's saying or not saying. So the new treasurer, he talks a lot about this 3-3-3 game plan, right?
Mm-hmm.
What I thought was interesting is that when we look at the national debt at $37 trillion, we look at the national GDP, which I don't know, it's a 25 or $26 trillion economy,
Mm-hmm.
right? So he's saying that if we can get real GDP at 3% consistently over time, that and we can fix the deficit problem, and so if we can get the deficit to GDP to 3%, and so if we don't grow the debt, but we continue to grow our economy at a real number of 3%, that he feels that in the next 10 years, even somewhere around there, that's so it's like growing your way out of debt in a way. So the percentage of GDP to debt to GDP then grows from today 105 to 110%. Maybe we get back down to 90 or 80%. What is your view? And then the last thing of that is the other three is getting to producing 3 million barrels more per day. What I don't understand the 3 million barrels more per day is if you're Chevron and Exxon and these big oil companies, why would you want the price of crude to go down? We know there's a break-even point. So how would that even work? I know that's a loaded question, but all yours.
Yeah. It's a three-part question because of the three-part Bessent plan, right?
Right.
Starting from the back, it's 3 million more barrels of oil per day seems like a lofty goal given where prices are today, and the fact that the U.S. is one of the if not the top producer of oil in the world. We're already cranking out 13 million barrels a day, right? And that's a record amount. So despite all the talk about climate change and climate initiatives during the Biden administration, all those came alongside an increase in fossil fuel energy production. So that's how we ended up with record oil and natural gas too output. And to add another 3 trillion barrels a day.
3 million barrels.
3 million, I'm sorry, what did I say? Yeah, 3 million barrels a day.
Yeah.
Oh, would be a bit much, right? But a goal is a goal, but you have to have the private producers be stimulated to do that. And if the price is not conducive for that output to come to line, then they will not do it.
I agree.
Yeah. So the only saving grace here for this plan, from my point of view, is if the energy extraction technology becomes more productive and allows for a lower break-even price. But I don't know enough about the energy industry to make a conjecture like that. So for me, it seems almost impossible that this 3 million barrels a day plus in energy will be reasonable to even expect. The other parts of the 3-3-3 plan seem more plausible, though. The U.S. economy is already growing at a solid 2+% annualized rate, right? And a lot of it is predicated on stronger productivity growth. And for the long haul, expectations are ours at NDR included for the next 10 years for the economy to grow at a 2.3% annualized rate. Now, granted, that's not 3%, but it's also just a projection. So perhaps if Bessent has a plan to stimulate the economy beyond the productivity growth that it's already implied in a 2 to 2.5% growth over the next 10 years, 3% could be achieved. Okay. For me, it kind of stands on the legs of productivity. If AI comes through and we do end up with an economy that is, much more productive than it is today, even though the U.S. economy is already one of the most productive in the developed world, then yes, 3% sustained growth is a reasonable objective. And if you have that along with 2 to 3% inflation, then you end up with nominal growth of 5 to 6%, right? So from that perspective, if the deficit if the deficit swelling is reduced, we will end up with an opportunity of having with the opportunity to grow ourselves out of debt, or in a way to put the debt to GDP in a more sustainable path, where it's not expanding unrestricted into future years, but rather to a more reasonable level, like you said, below 100% debt to GDP.
I mean, are you concerned about everybody is, right? So are you overly concerned about the debt and the deficits that we have as a country and what that can mean to the dollar?
I am, but not necessarily because of the impact it may have on the dollar, right? Debt to GDP and the deficit outlook overall, seem concerning from a point of view that, there are negative consequences for the overall economy. Yes, debt growth and deficit spending are stimulative to cyclical growth, but at the end of the day, what happens is that if you have unrestricted growth in government spending, you end up with, like you said, higher interest rates, higher bond yields, crowding out of private investment, all of these things could eventually weigh on the US dollar. But the US is in a very envious position compared to other developed economies, right? The dollar is still the reserve currency of the world. Treasuries, as well as the dollar, are safe haven assets. So as long as that remains the case, then the demand for treasuries will remain well supported, right? So that is what's keeping rates from going higher, let's say, or projected expectations for long-term yields to go even higher. And that is also what's keeping the dollar in a relatively stable and strong position right now.
I agree. I want to change it to housing. So from a housing market standpoint, the way I look at it is there's a lack of supply on the market and there's a lot of demand, but the demand, there's some reservations because of mortgage rates. So if you think about somebody in their late 20s, early 30s, right, getting married or married and looking to build a family, it's just so difficult for the cost of housing and mortgage rates. And I know housing is such a big part of our economy. What is your view of housing and your thoughts about it going forward?
It is in such a difficult position right now, right? There's, depending on whether you're a home buyer, a home seller, a builder, you can have a different view on what housing means to you, right? But for homeowners or prospective home buyers, the mortgage rate matters a lot, right? Housing prices, as well as the mortgage rate relative to household income, determines affordability. And that has been depressed for several years now, given that mortgage rates are where they are, like 2.5 times higher than what they were pre-pandemic, and how home prices, even at a more moderate pace now, are still growing and growing, faster than income, let's say. So from that point of view, affordability remains depressed, and this is what's keeping people from moving, let's say, or if they want to sell their home, they're postponing doing it because they cannot afford the new mortgage rate. This has been one of the reasons why supply of existing homes for sale has been so little, right? The month's available supply of existing homes for sale is still close to 3 months, and this is quite low. The what's considered normal for a balanced housing market is actually closer to 6. So as long as people remain locked into that low mortgage rate that they had prior to mortgage rates rising, there will be this sort of shortage, and that's the cyclical shortage, right? Over time, as income catches up to home prices and the market normalizes in a way, that cyclical imbalance within inventories will self-correct, right? There's already signs that there's what we call thawing in the labor market, housing market, that there's people have made peace with the fact that rates and interest rates in general and mortgage rates overall will not go back to what they were, the 2-3% prior to the pandemic. And life goes on, right? I mean, people move. There's housing requirements in terms of your family needs and all that require a move to a bigger house or a different house, and sales do happen. But they are still very much restricted. So there is some thawing in the housing market, but it's still very much limited. From a construction point of view, the structural housing shortage that has predated the pandemic and is still in place is what is actually helping home prices grow and makes the building of new construction, the bringing to market of new construction still profitable. So housing starts and building permits, they have not moved up significantly, but residential investment overall, let's say in Q4, was a positive contributor to real GDP growth. Whether that continues in the future is still debatable because it depends on financing costs and what tariffs do to imports of materials that may be necessary for construction. If you remember, one of the reasons why home prices rose as much as they do early in the pandemic was the supply chain disruptions that caused a lot of the materials that are necessary for a new home to be stuck somewhere, right? There were quite a bit of shortages that prevented the completion of new housing to come to market. So if tariffs were to cause a similar type of supply chain disruption, we may be off for another housing market snafu, let's call it here. But barring that, the improvement in builder confidence in recent months, as well as the stabilization, even though it is still high level of mortgage rates, suggests that we should see some positive contribution to growth from residential investment in 2025.
Terrific. And so, Veneta, I want to end with what concerns do you have about the economy, if any?
Well, like I said, I'm pretty optimistic about growth, especially in the first half of the year, because we're still riding on the sails of a very good, like you called it, a Goldilocks economy from 2024, right? There were so many good things that were supporting economic growth, and many of those trends, including broad credit conditions, like we said, the well-balanced labor market, continued fiscal support from the government, all these things are still going on, right? So this is what's driving the economy and keeps me rather positive for the overall macro outlook for the U.S. Where I'm not so sure, and I'm not, not worried, let's call it, is inflation, right? We do see inflation stable around 2.75% to 3.25% in 2025, but there are so many policy uncertainties here that could unhinge it. Then, my outlook here is only tentative, right? The policy uncertainty is what keeps me up at night, really, because I don't have a good sense of the priorities that are of the policy priorities from the Trump administration, and what the scope and timing of those will be. So now we know that immigration is a problem, and overhauling it is a tall ask, but some sort of immigration policy is going to come to happen this year. Right? I'm not talking about like the mass deportations that he was talking about on the campaign trail. By some estimates, there are some 10 plus million undocumented immigrants in the country here, right? So, deporting those in 1 year is just an impossible task, I would say. It's unrealistic to expect that to happen. Some deportations have already begun, right? According to media reports that we're seeing, but the mass deportations are just they just need logistics and cost, which means that they will probably not happen as quickly in 2025. But were they to happen, That means a significant decline in labor force, and specifically in several industries that rely on immigrant labor,
Right.
like construction and agriculture. And one statistic that I came across was for crop workers. The agricultural crops are being collected mostly by undocumented immigrants, if you will. Like 50% of the labor force in that particular sector is undocumented immigrants. If that is not, if those people, are deported, then you would expect that prices for food specifically will go up,
Right.
driven by those crop prices. Same goes for construction. There's a lot of immigrant labor in construction, other
Right.
industries as well. So the swift reduction in labor force may cause wage pressures to go up, which will be inflationary, and an unfavorable development from the Fed's point of view in terms of inflation, right? The
Yeah.
other thing is tariffs. You hear that tariffs are a one-time increase, and that's a price level change, and it's not a sustainable inflationary increase. But you mentioned in the beginning that it's not only inflation, it's the price level that bothers people. We know that inflation is down to 3%, and that's a third of what it was 2.5 years ago. Excuse me. But still, when you go to a restaurant and you go to a grocery store, you still see prices much higher than what they were prior to the pandemic. And that is one of the reasons why President Trump swept into office, right? Because,
Yep.
people were fed up with higher prices. Even though they're growing at a slower pace, prices are still too high for many of them. So what are tariffs going to do? If you put in a 10-20% increase on goods that are coming in from abroad, a lot of that, if not most, will get transferred directly into final pricing, and that's only on the tariffs on final goods. But because tariffs will be applied to intermediate and raw commodities as well, then that filters to the production process and through it into final pricing of other goods. So overall, tariffs will be inflationary, especially if they're of the magnitude that President Trump has talked about. Now Besant has talked about much smaller tariffs of like 2.5%, if you will, on all imports, but very limited. And if it's that much, then the economy can probably sustain it, and it will not turn off trading partners to the degree that a 25% tariff would. And counter tariffs of that magnitude, of small magnitude, would not be disruptive to either U.S. exports or imports into the U.S. So from that point of view, the inflationary impact would be much smaller. But like I said, it's the uncertainty that keeps me up at night, and what gives me a pause when I talk about the inflation outlook for this year.
No, it makes a lot of sense. I mean, everything you said. I mean, especially with the inflation, what could cause the inflation, immigration, tariffs. I mean, I think these are things that they feel like. I mean, there's always uncertainty out there, no matter what environment
Yeah,
we're in, no matter what year we're in, right? But it's all
yeah.
reasonable stuff. Veneta, this is excellent as always. I really appreciate your perspective and the information that you convey to all of us. Very educational. It helps all of us. So we really appreciate you taking the time to meet with me today.
It's always such a pleasure talking to you. I mean, it's always conversational about the U.S. economy. We talk about big things, but in office terms, so to speak. So I love
Yeah,
speaking with
yeah,
you. Thank you for
yeah,
having
yeah.
me on.
I agree. I agree. Thank you very much, and have a great day. We'll be in touch.